All right, I went ahead and started the recording. It looks like it's 7 o'clock, so we're going to go ahead and get started as we have a lot of information to cover tonight. Good evening. I'm Megan Baylor. I'm the Director of Education and Events. Thank you guys for joining us tonight to talk about your business finances. Obviously, this COVID-19 pandemic has caused major changes in the way veterinary practices do business. Lucky for us tonight, we have an expert with us to help us navigate these new federal acts from a financial point of view. I'd like to ask you all to use the Q&A feature to ask questions that you have along the way in the webinar. We will try and answer as many of them as we can throughout the presentation or at the end of the presentation. The Q&A feature is located down on your bottom bar for the most part, those of you on a computer. I will be trying to reply to them if they're already repeat questions, so we can only have to deal with one question at a time at the end, or the same question. If we don't have time to get to your question, we will reach out to experts and get those questions added to our COVID-19 resource page on the PAVMA website. Now, as a PVMA director, I want you all to know that we are diligently working to help provide veterinary staff in the state with timely and accurate information during this unprecedented time. If you're not currently a member of PVMA, I would encourage you to join to ensure that we are able to continue providing this information and services to our veterinary community. Right now, membership dues have been prorated for the rest of the year. So if you have any questions, feel free to reach out to any one of the staff members at PVMA. We're pleased to have with us tonight Jay Goldman. Jay Goldman is a principal at Boyer & Ritter. He is a certified public accountant and has over more than 25 years of experience with public accounting. Now, a full disclaimer for this is an informational webinar, so it's intended for education and informational purposes only. This webinar is going to be recorded and added to the PVMA COVID-19 resource page. So from there, I'm going to go ahead and hand it over to Mr. Goldman tonight.
Well, thank you, Megan, and thank you everybody out there for joining us. I've had the fortune of speaking to a few groups here recently about this topic, and the two things that I think I know are that people have a lot of questions, so I'm going to try to make sure I leave plenty of time for questions. And then I imagine what has probably happened in most cases at this point is you have probably applied for a PPP, a Paycheck Protection Program loan, and either have the money or have been approved and will get the money soon, and have a lot of questions around forgiveness. So those are the two things I want to devote a significant amount of the time to, but in order to get there, you kind of have to start at the beginning, and you kind of have to go backwards and go from the beginning. So I'm going to go pretty quick here for a while. I have a whole bunch of slides I'd like to get through. And like I said, some of the ones towards the end, I think are probably the ones you're more interested in. So I'm going to go pretty quick here at the beginning. I am going to get Megan all the slides afterwards. And so if you want to read things that are on the slides that I kind of go over pretty quickly, or as Megan said, it'll be recorded. There have been 3 laws passed in the last 6 weeks by the federal government in response to the COVID-19 pandemic. And we're going to touch on all 3 of those with an emphasis on the last one. Part of the last one is what we call the PPP, the Paycheck Protection Program, which is the government loan in place, the potentially forgivable government loan in place that is most interesting to businesses your size, small businesses who are suffering from government restrictions, government shutdowns, and having to lay off employees. And then the question is, will it be forgiven? What's amazing about this whole thing is that 6 weeks ago, everybody was still going to work, everybody was still going to school. It was still sort of this is going on in other parts of the world, and I don't know if it was maybe it won't get here or hopefully it won't get here. But back on March the 6th is when the federal government passed the first law. You'll hear a lot of people refer to it as COVID-1. And then the next ones will be COVID-2 and COVID-3, which is just ingenious. But the first law was COVID-1, and basically it was a behind-the-scenes thing. It was a funding mechanism. It was moving money around, getting money in place for the response for the hospitals and for the resources behind the scenes. So it didn't really have much impact on business or individuals. It was more of a Appropriations Act. It did give the SBA some money that they used on what we call economic injury disaster loans, and we'll touch on that in a little bit later. Then on March the 18th, so less than a month ago, they passed the second bill. This was the first one that was really going to start to directly impact more your employees than you, but you as a business owner a little bit as well. This was what they called the Families First Coronavirus Response Act. And this was where they expanded the Family Medical Leave Act, and they created this paid sick leave for small employers, basically under 500 people. And the idea here was they started to realize a couple of things. The schools were shutting down, and school, in addition to education, provides nutrition, food, and daycare, if you will, for a lot of working families. They also realized that people were going to start to have symptoms and maybe be in a position where they hid the symptoms in order to keep coming to work and in order to keep getting paid, because so many smaller businesses didn't have robust sick leave policies. So this was the law for that. There were six reasons why you might qualify. There's been a lot of confusion about the first one, which says the employee is quarantined or isolated by a government order. There's a lot of, when this was passed and when it was written, I don't think people were envisioning what the governors of states have had to do since then. And you know, when you start reading the definition of a quarantine order and isolation order compared to what's going on in Pennsylvania right now, it's actually hard to tell whether you qualify for that one or not. But the theory here is your employees would have been eligible for some money from the government. You would pay them either based on either sick leave or based on family medical leave, either 100% of their pay up to $511 a day, or 2/3 of their pay up to $200 a day, depending on which criteria they meet. And then the government would reimburse you through some payroll tax reduction. So in essence, you would be the conduit, but the government would be paying the sick time for your employees. Then just March 28th, only about 3 weeks ago, the big law got passed, and they were really working on this one before they even finished the second one. This is the largest stimulus bill in US history. It was $2.2 trillion of spending. It went from literally a blank piece of paper in the Senate, where they started working on it, to being drafted, passed in both houses, and signed by the president in 7 days, which is probably a record for the federal government. It also leads to a lot of problems because it's just not well written, and it's not completely thought out, because they were trying to just move as fast as they could. So it's called the Coronavirus Aid, Relief, and Economic Security Act. The acronym is CARES. You'll hear it referred to as CARES. You'll hear it referred to as COVID-3. The original bill was 900 pages long. And what it included was a whole series of things, but just to kind of give it some perspective, the Paycheck Protection Program loans, which is what we're going to spend most of our time talking about, was part of this. This is the law that expanded unemployment and created a federal unemployment subsidy on top of whatever states pay in unemployment. So this is the additional $600 a week that your employees are either, the folks that you've unfortunately had to furlough are either already getting or just about to start getting from Pennsylvania. This is the law that did the $1,200 checks that you heard talked about for a while, and I guess now we're starting to get direct deposited into people's accounts. So $1,200 for every adult and $500 for each child if you're below certain income levels. There's also a series of income tax changes that we're just not going to have time to talk about today, and they're not as necessarily urgent because, as you know, your tax return's not due until July. But some of them are retroactive. Some of them affect potentially your 2018 tax return, your 2019 tax return if you've already filed it. There's some individual tax provisions with retirement plans and charitable donations. There's 2 business tax provisions, the employee retention tax credit and the employer payroll tax deferral, that we'll talk about a little bit, but they were, if you do one of these PPP loans, it's kind of an either or. You can do the PPP loan or you can do these 2 credits. There's also some concern that, you know, some businesses might lose money in 2020, businesses that have historically been profitable. And when the tax law was changed at the end of 2017, they made some changes to how, what we call NOLs, which is a net operating loss, or overall business losses, the way you can net losses from business against income from other sources like your salary and your interest and your capital gains. They did some things that were unfavorable in that tax law, and they've loosened those for a couple of years, so that if people do have business losses in 2020, you might be able to get some tax refunds to help offset that. Some other changes with business interest. Currently there's a 30% limit on how much interest you can deduct as a percentage of your income. That's going to be raised to 50% more or less for 2 years. And then qualified improvement property, that has to do with depreciation. And if you have made some improvements, let's say to your office space, your clinic space, and you've done some some retrofitting inside or some building or some improvements, there might be some favorable depreciation rules. Again, all things that will either lower your taxes and maybe get some cash in your pocket while the business needs it. Talked about the unemployment a little bit. That's the $600. The EID loan, I mentioned that as part of COVID-1. That's the original SBA disaster loan program. It sort of is always there, but it sometimes sits dormant until a disaster comes along. This is something that folks can apply for. You can get up to a $2 million loan. You can get up to a 30-year payback period. The interest rate is 3.75% for for-profit businesses. But this is truly a loan. They've relaxed the underwriting some, but not completely, and it will get paid back, unlike the PPP loan. So the two credits that I mentioned, that again, if you did the PPP, which I'm going to assume most people did, these don't apply. But if for some reason you weren't eligible for PPP or you end up not getting one, there are two provisions out there that might help offset some of the costs. The first is what they call the employee retention credit. This is a credit against wages you pay to your employees, up to $10,000 per employee, and you can get a maximum of 50% credit. So potentially up to $5,000 per employee. It's for wages paid after March the 12th and before the end of the year. The way they give you this credit is you offset it against your FICA taxes that you would have to pay, the 6.2%, the employer share. And it would be refundable at the end of the quarter if they owe you more than you owe them. You had to be in business in 2020, and your business had to be substantially harmed by COVID. It's sort of either you were partially or totally shut down by a government order, or your gross receipts have dropped by more than 50%. So I think in any industry where the stay-at-home provisions have substantially changed your ability to do work, and you're functioning on an emergency-only basis, it would be pretty easy to believe that either one or both of these would apply to you. There's different rules if you have under 100 employees or over 100 employees. Relating to which wages count and which ones can go into that formula. And again, it's capped at $5,000 per person. Another option, again, not available if you do PPP, is what they call the payroll tax deferral. So, you pay your employees, you take 6.2% Social Security from them, you match it with 6.2% of employer money, and you typically pay that to the government within a day or a couple of days or a week, depending on how big your payroll is. With a federal tax deposit. What they're allowing you to do in order to improve cash flow is to stop paying the employer portion, the 6.2%, from March 27th through the end of the year. And then you accumulate all that, and you can then pay it to the government in 2 installments, one installment on the last day of 2021 and one installment on the last day of 2022. So this is just a cash flow timing thing. When it's all said and done, you'll pay them all the money, but it's sort of a medium-term interest-free loan from the government to help you out. All right, so now the big one, and the one that I assume most people want to talk about, is the PPP loan. It stands for Paycheck Protection Program. And I don't know why my slides are advancing on their own. I think I set something up wrong. So the PPP loan, again, as recently as a week or so ago, this was the main thing that we were talking about, was how do you get with a bank that can handle it. It's not going to be the SBA that processes this. It's going to be a bank. Last Friday, April 3rd, or a week ago Friday, was the first day that corporations and businesses with employees could apply. And then this most recent Friday, the 10th, is when independent contractors could apply. So this is a loan. You may be confused by some different terms that you've heard throughout the way, because when the law first came out, the law said that the interest rate would be no more than 4% and the payback period would be no more than 10 years. So a lot of people took that to mean it's going to be 10 years and it's going to be 4%. Then the Treasury Department came out a couple days later after the law came out and said the interest rate is going to be 0.5%, which is less than 4, so it complies with the law. and the repayment term is going to be 2 years. And then a lot of the banks threatened not to make the loans. So then the SBA came out a few days after that, and everybody settled on 1%. So if you're confused because you've heard 4%, 0.5%, and or 1% is the interest rate, at different moments in time, they were all the correct answer. The one you need to know for right now is that it ended up being a 1% loan on the part that's not forgiven, and 2 years to pay it back. In order to be eligible, you have to be a small business. They expanded the normal definition of small business that the SBA uses for these purposes, but at the end of the day, right now, there's some exceptions, but it's more or less 500 employees or less. If you owned a series of businesses, you would have to combine all your different employees together, potentially, depending on the control and that kind of stuff. You had to be in business on or before February 15th. You had to have employees. And you have to make what they call good faith certifications, and that's what's on this slide here. There is no underwriting. They're not trying to determine whether you need the loan, whether you have the ability to pay the loan back, whether you have cash flow and different covenants and all the things that you normally deal with when you're trying to get a loan. Because the whole point was they know that people probably would fail all that right now, and the banks aren't going to lend you money, and that's why the government is getting involved here. So you need to be willing to sign the following statements, and if you've already submitted your applications, you've already done it, but that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And again, I'm sure there's some industries where that might be problematic. The joke is the companies that make toilet paper probably don't need this because their business is doing really well right now. But certainly in the world that you guys live in, with all the uncertainty, and I'm sure all the canceled appointments and all the people who can't come in for the normal procedures that they would have done, there's plenty of uncertainty. You also have to promise that you're going to use the money primarily to maintain payroll, make your mortgage payments, your lease payments, and your utility payments. How much money can you get? It's a formula based on payroll costs. It's 2.5 months worth of the average payroll costs from the prior year. And the loan can't exceed $10 million for any one borrower. Payroll costs has a very specific definition, and it's important that you understand it. If you for some reason, if you haven't applied yet and you're still thinking about applying, or when we get into the forgiveness calculations, the same concepts apply. So payroll costs do include salaries, wages, commissions, compensation, anything you pay to your people in cash, cash type wages. Sick leave, vacation leave, dismissals, any kind of severance payments. And then the employer portion, the part that you pay towards their health insurance, their retirement plans, 401k, profit sharings or matches. And then the state and local taxes assessed on the employer portion. So basically the employer portion of SUTA. So what they're trying to do here, if you think about it, is they're going to encourage you either not to lay somebody off or to bring somebody back who you've already laid off. And they're going to give you the money to pay them. And if you do all the things that they ask you to do, they're going to forgive you. You're not going to have to pay it back. And they're more or less trying to make you whole because they're covering all the costs that go along with having that person. They're covering the wages and the employer portion of most of the expenses. The only thing they're not covering, and we'll see that on this slide, is the employer portion of the federal taxes, the FICA and the FUTA. The other thing they want to do is they want this to protect the everyday person, the more common person, I guess, for lack of a better word, not the wealthy. So they've determined that for purposes of this definition, the payroll costs is capped at $100,000 on an annual basis, prorated for whatever time period we're talking about for any one person. So if you pay somebody 150 grand, they still count as 100 towards this formula. That extra 50 just doesn't count. They have to be employees. We're not talking about your independent contractors. If you have independent contractors, they can apply for their own loan using their own Social Security number and their own income. Your employees have to live in the United States. And if you paid them any of the family medical leave or the sick leave, where the government is already the one paying for that, not you, you can't count that towards this. And that makes sense because that would be double dipping. I'm sure when you applied, the banks wanted certain paperwork from you, basically backup to prove all the numbers that you put on the application, whether those were payroll tax returns or copies of health insurance bills or copies of transmittals to your 401k company or whatever. In essence, the banks are the gatekeepers for this. The SBA just doesn't have the manpower or the staff to process all these loans. I've heard, I don't know if it's true or not for sure, but I've heard that the amount of loans that will be written under this program will exceed the number of loans that the SBA has done in the last 15 years on a cumulative basis. So there's just no way they could handle it. That's why they've gotten the banks involved. But they've given the banks a lot of authority to review the documents and approve and make decisions. So you would have had to accumulate your qualifying payroll costs, your health insurance, your retirement, your SUTA for a year, divide that by 12, multiply by 2.5, and that's how much loan the government would be giving you. And from what we're hearing, people, like I said at the beginning, are either been approved and the money is imminent or may already have the money in their bank account. I'm sure most of you did an application, so you know what the application looks like. It was only 2 pages. Some numbers on the first page, some yes or no questions, you know, about your qualifications, and then all the certifications about what you're going to do with the money and that you're going to spend it on the right things. Okay, so that was fast. I told you I was going to go fast, and that was on purpose so that we can spend more time from here forward. So the money that you borrowed, you have promised to only use it on certain things. So the first thing once you get your money is to make sure you only spend it on things you're allowed to spend it for. And you're going to have to prove all this. So a recommendation we're making to everybody, and I think some of the banks are making this recommendation as well, is to have a separate bank account where the proceeds of this loan go into that bank account, and only certain things are paid with the money that's in that bank account to A, prove that you did what you need to do what you need to do with the money, and that at the end it makes it easier to show the audit trail to the bank who's going to have to approve your forgiveness application. So this money comes in and you're allowed to use it on payroll costs, and those are the same things we talked about before: salaries, wages, vacation, sick, healthcare, retirement, state unemployment. You're allowed to use the money for somebody who makes more than 100 grand, but you'll see in a minute that when it comes to the forgiveness portion, they won't forgive any more than the equivalent of $100,000 per person. You can also pay the interest on a mortgage. If you own your facility inside your entity, you can pay the interest on the mortgage, but not the principal. If you rent your facility, you can count the rent. You can count all the utilities, and then you can count the interest on any other debt that's not a mortgage if that debt was in place prior to February 15th. So you're allowed to spend the proceeds of your loan on these things. But if you want to get the entire loan forgiven, you have to slightly narrow that list to these things. And the main differences that you will see here are the interest on a non-mortgage, which was on this list, is not on this list. And the compensation of a person over $100,000 for the prorated period is not on this list. So you have what's called a covered period. From the day you get the loan, from the day they put the money in your bank account, you have 8 weeks to spend the money on all those things that we said are eligible. And if you want to get full forgiveness, if that's your goal, then you need to spend all of it within those 8 weeks on these things that qualify. They added a provision, not in the law, interestingly enough, but the Treasury Department and the SBA added a provision after the law that said not just do you have to spend it on these things, but at least 75% has to go to the payroll and related costs, and at most 25% can go to the occupancy, the rent and the utilities and the interest on the mortgages and that kind of stuff. And they did a whole long write-up on why they thought that was better and why they thought that was the intent and what the government meant. So, and where this is all headed, I guess maybe I should have said this. I'm going to show you a spreadsheet in a little bit that we've developed, that we put on our website actually today. You guys are some of the first people to see it, but we've worked hard on a spreadsheet that'll help you get all this stuff organized and start to figure out where you're at as your money comes in. So in addition to having to spend all the money in 8 weeks, and in addition to having to meet this 75-25 test that they put out there, there's other things that you have to do in order to get maximum forgiveness. And what this all speaks to is what the government really wants is for you to either get your people back on the payroll, or if you never let them go, keep them on the payroll. And while it might be okay to cut their pay a little bit because it's a tough economic time, you can't cut their knees out from underneath them so drastically that it's really going to destroy the economy. So the two tests that they came up with that you have to apply to your loan in order to figure out your forgiveness, there's two. One's called the head count test. And what you do here is you take the average number of full-time equivalent employees during this 8-week period. And a full-time equivalent employee for this purpose is a 30-hour-a-week person. So anyone who works 30 hours or more is one full-timer. And any part-timers, you add up their hours total and divide by 30 and see where you get. So 2 15-hour people would be the same as 1. 3 10-hour people would be the same as 1. So you do that for the 8 weeks that's in your loan proceeds period, if you will, this covered period. And that's the numerator of a fraction. And then you compare that to a denominator, which is either the number of FTEs you had from February 15th through June 30th of 2019, or the number of FTEs you had from January 1st, 2020 through February 29th of 2020. You can pick whichever one's better for you. So you might have, had 20 employees on average in that period of 2019. You might have had 25 on average in the 2020 period. So you're going to want the smaller one. So you're going to go with the 20. And let's say during our 8 weeks, we only end up having 15 people. We have a ratio of 15 to 20. That means we have 75% of the people. That means we could potentially get 75% of the loan forgiven, but not more than 75%. The second test that they have you do is what they call a salary reduction test or a wage reduction test. And it says for certain people, and I'll come back to who those people are in a second, if you cut their pay by more than 25% from what they made in the first quarter of 2020 during this 8 weeks, if you take somebody who was making $1,000 a week salary, let's say, and you ask them to come to work for $750 a week, that's okay, because that's not more than a 25% cut. But if you cut them down to, let's say, $500 a week, you ask them to work for half their pay, that's going to work against you in these formulas. The people that are part of this calculation, not all of your employees go into this calculation. Anybody who made more than $100,000 as defined, and I'll come back to that in a second, in 2019 is excluded. So in essence, the higher paid people from 2019 will be excluded from this calculation. But the way they determine $100,000 during 2019 is that during any single pay period at any point in the year, if their pay on an annualized basis would have put them over 100, they're excluded. So depending on your pay plan structure and whether you guys have, whether there's bonuses or whether there's raises during the year, or, if not everybody's straight salary, you kind of have to do the math and say, if you pay weekly, it's like $1,900 and some odd dollars. So if any 1 week that person made $2,000 for whatever reason, even if they didn't any other week, they would be excluded from this calculation. So it's going to be, you're literally going to have to look through your payroll records for the entire year of 2019 probably to figure out who is in and who is out of this calculation. Having said everything I just said, it's not a well-written law, and there's a lot of questions that remain unanswered, and we hope to get more guidance on these particular provisions. And every day we look to see if they've released them, because here you are, you either have the money in your account or you almost have the money in your account, and I say it's almost like signing it's almost like you've signed a note with the bank and they've left the interest rate blank and they're going to fill it in later because they just haven't given us a lot of the rules on how they want some of this to work. But those were the general concepts. There'll be some clarification coming, but you just have to kind of understand right now that there's more questions than answers. They've given you an opportunity. So if either one of these two reductions that would hurt your ability to have the loan forgiven apply to you, they've given you some opportunities to correct that retroactively after the fact. I guess that's the same as retroactively. But unfortunately, if the previous section of the law was poorly written and hard to understand, this part is that much more poorly written and that much harder to understand, to the point where it's almost impossible to give advice right now on how you can actually take advantage of these provisions. But at some level, what they're saying is, even if you've already laid people off because of what's happened to your business, if you bring them back, and you bring them back by certain points in time, we'll count them against your percentages, against your FTE percentage or against your wage reductions, will give you credit for undoing some of the damage that was already done. What the law says is you look at February 15th through April 26th, you compare that back to April 15th, and if you fix it by June the 30th, it's as though it didn't happen. But that raises a lot of questions, because if you read it very literally, it effectively says I could hire a whole bunch of employees back on June 29th, pay them for June 30th, and then fire them again on July 1st. And I've read the law a number of times, and there's nothing in the law that specifically says that's not what, that wouldn't work. But we also don't believe that's the intent of the Congress or of the Treasury Department. So we think when these regulations finally do come out, they're going to say something a little bit different. So, and then there's something similar with the wage piece. If you paid them less than what they used to get paid, there's going to be a chance to quote unquote make them whole, is what the law says, but then it doesn't go on to define how you do that. So if and when we get more clarification from the government, hopefully sooner rather than later, we'll figure out a way to pass that on to you. But for the time being, you kind of have to go with the numbers you have, with the people that you have, with the pay rates that you're going to have, figure out the math, and then hope that maybe you can make it a little bit better once you get this information. After the 8 weeks are over, you're going to have to apply for forgiveness. You're going to have to submit a package to the bank, and you're going to have to basically document all of those numbers that went into these calculations that we just talked about: your payroll, your wages, your head counts, your benefits, your retirement plans. So I would consider, like I said, we think a separate bank account right now is a good idea. We think making copies of some of this stuff as you go, you know, depending on how you do payroll, when you get your payroll report for the week or the biweekly, throw a copy of that in a folder. When you pay your rent, make a copy of the check and throw that in the folder. When you get the bill from the health insurance company, make a copy of that and throw it in the folder. And you're just going to make your own life a little bit easier at the end. Then you're going to submit all this to a bank. They're going to review it, and within 60 days decide if they're going to forgive your loan or not. One of the really pieces of good news is that whatever portion of the loan is forgiven is tax-free. That's not the way the tax code normally works. If you owe somebody money and they tell you, you know, it's forgiven, you don't have to pay them, that's normally what we call cancellation of debt. And cancellation of debt is typically taxable income. But in this case, it won't be. So that's a nice little nugget on that part. If at the end of the loan you do the math and not the entire loan is eligible to be forgiven, it will convert to a regular loan that you have to start repaying. It'll continue to be guaranteed by the federal government, so the banks have very little risk. As I said before, the interest rate's 1%. The term is 2 years. The interest will accrue from the beginning on the entire loan, but whatever portion of the loan is forgiven, the interest will be forgiven as well. So you'll only end up paying interest on the part of the loan that you have to pay back. There's no prepayment penalties, so if you have the money, you can pay it back at any time. And 6 months after you get the money is when you'll make the first payment. So it's really almost a 2.5-year loan with 6 months of no payments and then 2 years of amortization. This, I kind of already covered this. This is some of the documentation that we think the banks are going to want at the end when it's time to turn all this in. So literally today, just as the timing goes, we've been working on an Excel file to help people try to track all this stuff, help figure out where you're at, and maybe help make some decisions about how much you should pay people, when you should bring people back, how many people you should bring back, who you can afford to you know, leave on unemployment or whatever. So this is a link to the website. I'll make sure Megan has this when we're off. It's down here on the bottom as well for how you get to it. I'm gonna switch here for a second. I'm gonna turn off my screen for a second while I go get the Excel file up and then reshare my screen. So bear with me for a second. Okay, so did I do that right? Can you tell me if you're seeing, Megan, are you seeing the Excel file or are you still seeing the website?
It looks like the Excel file.
Okay, all right. So it's got a series of tabs, and the first thing it does here is it explains that this is a planning tool. not a precision tool. And what we mean by that is, and I said it before already, I'm going to say it again, there's a whole bunch of unknowns. There's a whole bunch of things that are unclear in the law. There's a lot of clarification that we're still waiting for. So what we've done, because we know our clients and the folks we're talking to are anxious to start doing something, start trying to gather some information, we put together the best we could put together based on the information we have today. And there's a chance that we'll all wake up tomorrow morning and the government will release a document and we'll have to get back to work and make some changes, and we will. And we'll continue to update this as we get information. But to the best of our ability, it's accurate as of today. But again, this is meant to give you some guidance as to what your loan, what might happen to your loan based on what's going on with the information we have. So understand that. There's instructions on each page, but you would come down here, and the first thing you'd have to answer is, when did you get your loan proceeds? And let's say you get your money deposited into your account tomorrow. And how much was your loan? Let's say it was $500,000. So that starts to fill in all the other information and guide you through the rest of the process to start modeling out, some of the decisions you might need to make. This tab here says introduction. It's sort of a reminder of a lot of the stuff that was on the slides that we either did talk about or glossed over for the sake of time, but it walks you through some of the definitions, some of the important dates, some of the information you probably need to gather before you start filling this in. So it also, again, down here says that there's some parts that we just haven't attempted to do yet, specifically those rehire provisions, that June 30th stuff. We didn't even attempt to put that in here for now because it's so unclear, and we don't want to give you a rosier picture than what it really is. Then there's specific instructions on what to do for each tab, and we'll go through some of those in a second. But again, it reminds you some of the dates, some of the amounts, some of the reasons why you're doing what you're doing. So anything in this light green color is where you'll fill things in. Everything else is calculations for you. So in this case, I said it's a $500,000 loan. And you might remember I said one of the provisions was that you have to spend at least 75% on payroll related costs. So that's $375,000, and at most $125,000 or 25% on the non-payroll costs. And as you fill these in, it'll revise these numbers to say whether you're hitting that maximum, whether you're over it, or whether you're under it. So the salaries we'll get to in a second. That's on the next, that's 2 tabs from now. But whatever you would pay in your share of the health care for the 8 weeks here, whatever you're going to pay in retirement goes here, whatever you're going to pay in state unemployment. So you start to build that up. Let's say you don't own the building, but you pay rent. So let's say your rent's $20,000 a month. So that could go here and here, and you're going to have some utilities every month. Let's say it's usually about $5,000 a month. So right now, and this will update as we go. Right now, it's saying you're not going to get the whole 50,000. You're only going to get 21 because that's how you pass the 75-25 ratio to this number. But we don't have the payroll in yet, so we'll come back to that. So one of the tests that we talked about was the FTE test, and the FTE test was the average FTEs for the 8 weeks inside your covered period, and then you get to compare that to either those 2019 dates or those 2020 dates. And again, a full-time person is 30 hours. So for every full-time person you have, count them as 30. For every part-time person you have, figure out how many hours you paid them for. So let's say this week, let's say you have 5 full-timers, so that's 150 hours, and you have 2 part-timers that work 10 hours each. So you might have had 170 hours that week. And maybe it was the same, maybe some people worked a little more, maybe you get busier this time of year, maybe you have an extra person. So you fill this in for all these different pay periods, and you're literally gonna have to go back to your, either, depending on how precise you wanna be, you can either estimate based on what you know about your people, or you could go back and look that up. Whoops. And this is a partial week, so I'm just guessing at the numbers to try to get something that makes sense, because that was on February 15th. If you look at a calendar, it's not a full week. So here's how many hours we worked, capped at 30 per person. So in this particular case, in this period of time, we averaged 6.4 people, 6.4 FTEs. we can look at this time period. And in this time period, we averaged 7.3. So we're going to ultimately use this one because we want as high a percentage as possible. So you want the lowest denominator that you can get. Then you could start to estimate, okay, what am I going to do in my 8 weeks? And you'll notice back here, we said it starts on April 15th. So this starts with April 15th. This whole thing is done on a weekly payroll cycle. If you're biweekly, just kind of cut your numbers in half. This is all based on a Friday payroll date because we think that's the most common. And it was too complicated to build it to do where you could like pick your actual payroll date. So you might have to do some smoothing out of the numbers to make it work. But again, it won't be, it'll be close enough for what you're trying to accomplish. So let's say with everything that's going on, you're down to 3 people right now, and you're going to stay at 3 people for a while. And then hopefully, you know, maybe on May 1st, the business starts to come back. So you're going to bring back 1 person. And then maybe by here, you'll bring back another person. So let's say those you're going to have 90, you're going to have 3 full-timers for a while, then 4 full-timers, then 5 full-timers. That gets you up to a 5 FTE. And you have to compare the 5 to this 6.4, which is lower than the 7.3 we got down here. So you've achieved a 70, you've restored your head count to 77%. And therefore, of the cost that you've incurred, which is still going to change on the next tab, you can get 77% of those forgiven, but you've now, based on this fact pattern, lost out on certain money. So the planning opportunity is to later on say, okay, well, maybe it makes sense, even though I don't really have work for this person, maybe it makes sense to bring this person back sooner and get this number up, which brings this number down. And that's where you can start playing with this thing to see what it means for you. All right. This is actually the hardest part because you're doing 2 different things on this page. You're building up how much you're actually going to spend on your people during the 8 weeks, so that can feed back into the calculation. You're also going to see if you pass that second test, which was the 75% of what I paid them in the first quarter. So you need to get out your payroll reports for the end of the first quarter. You need to figure out how many people you paid. And it would be anybody that got any amount of money, and put in their names, you know, whatever, however you want to do it or whatever, put some names in here. And anything in green and or blue you fill in, everything else is calculated. So how much did you pay? I'll put Bob. How much did you pay Bob in the first quarter? You paid Bob $15,000 in the first quarter. That means if it was an entire year, Bob would have made $60,000, which means in the 8 weeks, in order to achieve 75% of this equivalent, you have to pay Bob at least $6,923, or there's going to be a reduction in your loan forgiveness. Unless Bob was one of those people that went over that $100,000 that we talked about last year, that $1,900 a week or whatever, and we're going to say no for right now. He didn't. And then is he hourly, and how many hours does he work per week, or is he salary? So if he made $60,000 a year, so let's say we haven't done anything with Bob. Bob's important, and even in the slow times, Bob came into work every day, and we kept paying everything. So if we had to furlough them at any point in time, you could put that in here, and if you plan to bring them back at a future date, you put that in here. So we'll leave that blank for now. So you can see week 1 was a partial week just because of the way the pay plan. So we got the $1,154 every week. Bob made $9,231 in the 8 weeks. So the first thing is that number can't be more than $15,386, which is the equivalent of $100,000 a year for an 8-week period. So that number will be capped out there, and I'll do an example of that in a second. And then if this number here was less than that 75% number, you'd see a negative number here. So let's do some other examples. Let's say Ray made $10,000 in the first quarter, and Ray's a $20 an hour and averages 25 hours a week. But while things were slow, we actually let Ray go. Oops. 03/01/2020. Sorry, we actually had to let Ray go when things got slow, And we're thinking hopefully by May 1st, things will be a little bit better and we can afford to bring Ray back. So won't make any money here, won't make any money here. We'll start to make some money here. But what's going to happen is because we paid Ray $10,000 in the first quarter, which works out to we have to get Ray to at least $4,615 in the 8 weeks, or else we're going to get penalized. And we come across here and we only got to 2,800, then we're going to get penalized. So maybe we say, okay, well, we might have to give Ray a $2,000 bonus in order to make that go away. So these are where you can start to play with whoever does the payroll and the bookkeeping to start to figure out the benefits of doing different things at different points in time. And then the only other thing I'll show, so let's say this person's the big shot. They made that much money, but they were over. If they made that kind of money, they probably went over last year. So when you get to over here, no matter what you do to that person, because we put a yes in that box, you're going to get a 0 over here, no matter what, because they're not going to cause you a reduction. In essence, the government considers them rich, and you can do whatever you want to the rich people, I guess, is what this comes down to. But even though you would pay this person $32,000 based on their salary, the government's only going to allow you to count $15,000 towards the forgiveness. So then this here, all these numbers here, and again, these numbers aren't necessarily going to work because I'm just making things up as we go along. But that goes back to here. And obviously, let me make the loans smaller so we have something a little bit more manageable to look at. So you got a $100,000 loan, you have to spend at least $75,000 on this kind of stuff in order to get maximum, and we did because we're at 92. Down here, I'm saying we spent 50 on these categories, but it can't be any more than a 75-25 ratio to this, so we're capped out at 30. So we have 92 and 30 that we spent that qualifies, right? And that's so we have a $100,000 loan, 92 of payroll, 30 of non-payroll that qualifies, but we lose out of $20,000 here. We lose because of the percentage, because we only got to 75% or 77%. We lose out here because we didn't pay certain people exactly what we needed to pay them. In this particular fact pattern that I just created, we're okay because even when you do the math, we're still over 100 grand. So we'd be able to get the entire 100 grand forgiven. But if you start, obviously, if you change a couple of facts, if Bob, we brought Bob back, but was only able to pay this much. Now there's a negative here. So now this number goes down. So now we'd be left, we'd get 92,000 of our loan forgiven, but we'd still have to pay $7,000 back. So those are the parts that we think we understand so far. Like I said, there's going to be one more step, which is a way to even overcome, to make this 19 go away and to make this 4 go away by doing something else by June 30th. But it's just not clear what they want us to do in order to make that happen. So with that, Megan, if you want to open it up for questions and throw some questions my way, we'll see if we can answer those.
All right. So I just saw somebody posted something in the chat. Okay. Our first question, does the governor's order for medical facilities to report PPE supplies apply to small animal clinics? And if so, where does that information be reported? I'm wondering, now, the governor or the state board did send out stuff today about where to report for PPE, and I can definitely forward that to the person who asked this question. But is that in any way related to like supporting for tax deductions or anything like that?
Not particularly familiar with that, but I don't believe that would relate to any of the stuff we're talking about here. This is just again, the payroll and the rent and that kind of stuff for the purposes of getting this loan and then trying to get the loan forgiven.
Okay, my next question is the $1,200 check an advance on your 2020 tax refund? There's a lot of misinformation floating around, so they just want to get clarification for their staff.
Yeah, I don't know. I haven't really focused at this point on how it's all going to play together, but yes, at some level, my understanding is you won't have to pay it back. If they choose to give it to you, no matter how the math works out, you won't have to pay it back. But potentially when you do your 2020 taxes, your refund won't be as big as you thought it would have been because you got this check now. I'll look and see if I have anything else more specific on that, but that's my understanding of that. So yeah, if you have filed your 2019 tax return already, they're going to use that to determine if you qualify. If you haven't filed it, then they'll go back and use your 2018 tax return. Right now, they're only doing direct deposit for people who gave them their bank account information when they did those tax returns. But supposedly by the end of this week, there'll be a website up where you can go in and provide your direct deposit information if the government doesn't already have it, so they can get you your money that way. But they are calling it a recovery rebate or an advance that will somehow play into your 2020 tax return.
And if you feel like I'm not representing your question appropriately enough, feel free to reword it and add it back to the Q&A section. Just wanted to let everybody know that. I am a 1099 independent contract relief veterinarian and no employees, or independent contractors. Normally practices hire me to fill in. Since many practices I would work at no longer need me, I've lost most of my income. Can I get a PPP since the certification is to have employees or other independent contractors, which I do not?
Yeah, so I was focused on the business owners, the corporations or the partnerships that are functioning. There's a separate set of rules that exists for self-employed or independent contractor people. Fortunately, actually, there had been even less clarity on what those people were supposed to do, but we got some good information today. And you can basically look back at last year. Most people in that situation will file a Schedule C as part of their tax return, which is where you keep track of your revenues and expenses, for your business, which is being the temporary person, the temporary vet. So you'll be able to use some of the revenues that you generated and the net profit that you made from your quote unquote business in order to get an advance. And then literally today they came out with some guidelines on how you're going to get your forgiveness. And I didn't really have a chance to memorize all that yet, but I do know it was good information. It was favorable for somebody in your situation. We were pleased with what we read today. I just am not in a position to quote it right this second.
Okay.
My email's on the last slide. So if you want some more information on that, shoot me an email tomorrow.
Will health insurance payments apply to the owner of the business too if the owner gets payroll, i.e. an S corporation?
Yeah, as it stands right now, based on everything we've read, they have not done anything to treat owners who are employees of the S Corp any different than any other employee. We have some businesses where you might own your facility in a separate entity and are effectively paying rent to yourself. They haven't said anything about restrictions on rent to yourself. They haven't said anything about salary to yourself other than the $100,000. They haven't said anything about the health benefits to yourself as being anything other than just the numbers.
Okay. Regarding the PPP, what if you don't need the full amount of the loan granted? Do you still need to accept the full amount? I applied for the loan to pay my employees I applied for the loan to pay my employees who I had to make part-time.
So that's a good question. I'm not sure. I'm not sure if you have the ability to accept less than the full amount. I know if you think about it, the math was 2.5 months of payroll when you were paying everybody at full payroll basically. And now this new amount is, you only have 8 weeks to spend it. So even right there, you're off by at least 2 weeks, even if you were at full staff and you were at full payroll. You do have the ability to, there is no prepayment penalty, so you can pay it back at any time. So I guess you could take the money and then immediately pay it all back, or pay back the part that you don't want. You'd have to check with your bank, I guess, on, once you get approved, the bank gets paperwork from the SBA. The bank has 10 calendar days to finish the loan and get it funded. And I honestly don't know what would happen if you said to the bank you wanted to take less than the full amount. But I would ask your banker.
Okay. So we can give, I'm sorry. So we can bonus employees and have it covered by the PPP loan. We can bonus employees.
It appears that you can. There's, as long as you stay underneath that $15,000 number, you should be able to pay your people, even if it's, there doesn't appear to be any prohibition against paying them even more than what they were making before if you want to. I know some clients I've talked to, depending on your volume, it may or may not make sense to bring everybody back, but you have to get them on the payroll. So you might be paying people who aren't working, and that might be hard for the people you're paying who are working to comprehend or to accept. So I know some people are talking about maybe paying the people who aren't working at the 75% rate, and then maybe taking some of that money and giving it to the people who are actually working, maybe at get them closer to 120% of what they used to make. So at least there's some disparity between, the effort of coming to work and the effort of staying home.
This is somebody saying, I heard today from a banker that the PPP program will run out of money tomorrow evening, and he's encouraged anybody to be sure that their application has been submitted through the SBA portal.
I heard the same thing today. I heard it from somebody who supposedly will talk to their congressman, so we'll leave that for what it's worth. I would clarify a little bit. You do not apply for a PPP through the SBA. You apply for a PPP through a bank that has been approved by the SBA, which for this particular loan is almost any bank you can find pretty much. Some banks have stopped accepting applications because they think they're going to run out of money. Some have reached their limits. If you haven't done anything yet, I would start with the bank that you have an existing relationship with. If not, there are some other banks that have done a particularly good job of being on the front lines of this and understanding what's going on. And if you can't find a bank and you're looking for someone to talk to, I guess email me and we'll give you some names. But I don't think I'm gonna put them out there just right now. But yes, I would. If you haven't done anything yet, I would hurry up, because there is a couple of rumors that they're going to run out of money in the next couple of days. And at one point in time, they tried to go back and get more. It was $349 billion. It was how much was appropriated for this. Last week, the Congress raised the concept of another $250 billion, and that did not get through. At the time, it wasn't really needed, so it's a little bit different. I wouldn't be surprised if they were able to approve some more money, but there's certainly no guarantee.
I had somebody requesting if you could display the web address for the Excel program again.
I can. Give me a second, because I gotta.
And then I will also follow up after this webinar, probably tomorrow, with an email to everybody who's in attendance with the links. And Mr. Goldman did say he would give me a PDF of these slides as well as a link to hopefully the recording we can get on our website. So I will be able to follow all of that up tomorrow with everybody while he gets that lined up.
So hopefully I did it right. I think it's back to that slide.
Oh, I see it.
Okay.
Okay. We have not received any word from our bank. Should we be pestering them?
I'll assume that means you applied and that you're waiting to hear from them. Yes, I would say pester them on a daily basis is the advice that I've been giving people. If the bank's doing everything that they need to do, from what I have seen, and just from anecdotal stories with clients, it actually moves pretty quick. It's not because there's no real underwriting. They gather your information, they type it into a computer. I know for a few days the computer system was crashing a lot, but there were many people that were at least getting the tentative approvals within 1 to 2 business days, and then getting documents within a week after that. And I know we had clients get funded as early as, this thing opened up on April the 3rd, and I know we had clients that had their money by the 9th, at least, or the 10th. So yeah, if you're not sure what's going on, I would get in contact with your bank. Some banks have been more efficient than others.
Okay, this is a long one. Under the PPP loans, we are supposed to maintain staff levels and pay people their average hours for the last 6 months. If we have a staff person on leave for the month of April, a partner that had a baby scheduled before this all started, am I supposed to pay her during the leave? I have a second staff person, pregnant, due at the end of the month. Doctor wanted her to self-quarantine for 2 weeks before delivery. Do I pay her while she self-quarantine? No concern that she is sick. Last, a staff vet who is immune compromised stopped working when this all started. Do I pay her?
Wow. When do you have time to take care of the animals if you got to deal with all those issues? Those are all excellent questions. Those all fall into the category of we just don't have guidance yet. The FTE concept is one body is replaceable with another body. So if you used to have a part-timer and that person moved and you hire another part-timer and you give them the hours, that's all about hours. There's no issues. On the money piece of it, it says employee by employee. The only exception that it provides for in the law is that $100,000 in the prior year exception. But those are excellent. Those are better examples than the ones I usually use when I'm trying to make things up for these talks about, somebody had already given notice and was going to quit anyway. Unfortunately, I have a client where somebody died and they're not going to come back and, to get paid or whatever. So, as it's written right now, the only exception to that part of the rule is that 2019 thing. I believe there'll be other exceptions when the regulations come out for the stuff you're talking about. Maybe you put some of those people on sick or FMLA and maybe that changes something, but I'm not confident in that answer.
Okay. Since the idea is to make your employees whole for the situation beyond everybody's control. I'm sorry, he finished it down here below. Since the idea is to make your employees whole for the situation beyond everybody's control, can you pay them their normal pay even for less hours that they're working and have the loan forgiven?
Yes.
So,
yes. I think part of what happened here is when this whole thing was started, I think they thought that when it got out to the market, when it got out to us, we would be in a situation where business was slowing down dramatically and we were trying to decide whether or not to do layoffs and whether or not to do furloughs. And I think the intent was, if it's not going to cost you anything to keep them, there'd be no reason not to keep them, and then everybody keeps getting paid and nobody goes through. And then what happened was everything escalated so quickly, and the governor came out and did what the governor did, and people started making business decisions that they had no choice but to make, and started doing furloughs and layoffs before this program could kick in. But if you think about it, if you've laid the person off, they're on unemployment, and that means the government is trying to figure out how to process all the paperwork, pay them, do all the things that go along with getting somebody paid. And if you bring them back, whether they come to work or not, whether they work all their hours or part of their hours or none of their hours, if the government just gives you one lump sum of money and then makes you do all the paperwork to pay the person, I've been joking saying in essence, you've been deputized to be the payroll department for the Federal Unemployment Agency. which doesn't exist because right now everything's on state unemployment. So I don't think they don't really care whether the person's working or earning their check, so to speak. They just want to keep money in their pocket so they can pay their bills and pay their rents and pay their mortgages and keep the economy going.
Okay. If you're a 1099 and apply for the PPP, can you also apply for unemployment, since it seems that 1099s can get unemployment for at least from the federal government?
The unemployment side of this is not my strength. There have been new rules put in place that that self-employed people do now qualify for unemployment where they might not have in the past. I'd have to look into the interplay with specifically a 1099 person getting one of these loans. I would think if you got one of these loans and you're going to try to claim that the way you get the loan forgiven is to, in essence, say that's replacing your income. And I don't think you'll be allowed to do sort of both at the same time. Because I don't think the intent would be that you were, if you're using the loan proceeds to replace your income, then it's as though you're being paid and therefore you're not unemployed.
We have closed for 2 weeks due to staff exposure and just opened up Monday again. We were advised to have the staff file for unemployment. When the claims come in due, we deny them and pay them with the PPP funds, or let unemployment take care of the 2 weeks that we were forced to be closed?
So you can't start using your PPP funds until you have them in the bank. Your 8 weeks starts on the day you get your money. So if you don't have your money yet, then those people were unemployed for those 2 weeks and should be on unemployment. And then you would effectively rehire them no sooner than when you get your money, or there might be some strategies, you might be better off to wait a little bit to rehire them depending on some of these rehire provisions. But nothing that you spend before the day that the loan proceeds go into your bank account will count towards forgiveness.
Okay, and I see this in the comments. We've cleared all the Q&As in the questions, but a lot of people have posted to the comments, what if this goes past 8 weeks?
My personal opinion, which is all that it is, the government didn't just spend $2.2 trillion in order to delay the next Great Depression by 8 weeks. I think when they did all this, they picked 8 weeks because at that point in time, everyone, I think, kind of sort of thought that, my God, this has to be over within 8 weeks. It can't go on longer than that. They're already working on whatever COVID #4 law is going to be. I don't have any insight into what that will be, but I wouldn't be surprised if there's another round of loans. You get another set of money, you keep doing the same thing, or they extend the $600 unemployment or something. But yeah, it's a great question. It's kind of scary, but I mean, the closer we get, the more it doesn't feel like 8 weeks is going to be enough, that we're going to be back to sort of normal, if you will, whatever that's going to be in 8 weeks. So I would fully expect the government to come up with the next batch of whatever it is that they're going to do and continue to try to prop this thing up as much as they need to, so that when we get the vaccine or when it burns itself out or whatever the case may be, we still have an economy. Do you have anything else, Megan?
I'm looking here through the
Okay.
chat. Another Q&A popped up. I sent a question earlier today, but it was not addressed. My question is, I have an employee who applied for unemployment due to young children at home. Does that affect our PPP loan forgiveness if we keep our payroll numbers the same?
So if they're at home because they have young children and the schools are closed and they have no daycare, then they would qualify for that that new FMLA program, which will pay them 2/3 of their pay up to a maximum of $200 a day, and the government would pay you back for that. So if they're on that program, they wouldn't factor into the PPP program. I'm not sure if they're on unemployment, and you offer them their job back, they're sort of obligated to come back, or they could lose their unemployment. So in that case, I think it would work against you.
All right. I see one question here that I'm not sure if we answered, kind of lost track, but what counts for group health insurance? And then they have dental ? Long-term disability ?
Yeah, it's definitely dental health and vision. If in most people I've talked to, you find and maybe your situation is a little different. And in a lot of cases, the employee pays a lot of those extra ones. The disabilities and that kind of stuff is all employee paid. But if there's an employer contribution to that, it's not spelled out in the law what is or isn't included, but I would be inclined to include anything that the employer contributes towards the overall health benefits of the employee.
Well, that looks like we've cleared all of the questions in our bank. I don't see any more coming through on the chat or the Q&A. So with that, I think we can call it a night. I'd like to thank you all for joining us tonight. Do you have any last remarks, Mr. Goldman?
No, we will. There will be updates to this workbook. If you have questions, once you start using it, let us know. We as we learn more, we'll try to keep it updated. If something really significant happens, maybe we'll reach out to Megan and see if there's a chance to get back together and chat some more. But I just wish everybody the best of luck. I know it's a crazy time. It's just frustrating for all of us, and we wish we knew more, but just good luck to everybody.
So thank you again for joining us tonight, Mr. Goldman. We really appreciate your expertise. As a reminder, we are going to try and post all of our resources down at our COVID-19 resource webpage. You can find tons of resources there that we are getting in by the minute, it seems, these days. Thank you all again for joining us. We do have another personal finances, looking at what's happening with your retirement funds, how to properly deal with your investments right now, happening on Thursday night. So head over to our website to go ahead and sign up for that as well. So with that, I wish you all a great night. Thank you again.
All right. Thanks, Megan.